Hello and welcome to our channel. Today we're going to talk about something that might sound complicated, but is actually quite important for anyone interested in investing, especially in property. We'll be looking at the latest financial results from a company called Mapletree Pan-Asia Commercial Trust, or MPACT for short. Before we dive in, a quick and important disclaimer. This video is for informational and educational purposes only. I am not a financial advisor, and this content should not be taken as financial advice. Please always conduct your own research and consult with a qualified professional before making any investment decisions. Now, you might be wondering, what is a Mapletree Pan-Asia Commercial Trust? Think of it as a large company that owns significant buildings like shopping malls and office towers in several major cities across Asia. We're talking about places you might have even visited, like the largest shopping mall in Singapore, VivoCity, and the popular Festival Walk in Hong Kong. As an investor, one can buy a small piece of this company called a unit. When the company earns income from renting out these properties, it may share a portion of that with its unit holders. In this video, we'll break down their latest report for the first quarter of their 2025-2026 financial year. We'll explain to you in a simple way to help you understand what's going on with their business. Let's dive in and make sense of the numbers together. First up, let's look at the key numbers. Think of this as the report card for the company. The first important number is the distribution per unit, or DPU. This is the distribution a unit holder would receive for each unit they own. For this quarter, MPACT announced a DPU of 2.01 Singapore cents. This is slightly lower than the 2.09 cents from the same period last year. The presentation states this is mainly due to challenges in its overseas markets and the divestment of a property called Mapletree Anson. Next, we have the net asset value per unit, or NAV. This represents the theoretical value per unit if the company were to sell all its assets and pay off all its debts. MPACT's 17 properties are valued at $15.7 billion. The NAV per unit is currently $1.74. This is a small drop from $1.78. The main reason for this change is that the Singapore dollar has strengthened against other currencies like the Hong Kong dollar and Japanese yen, which makes their overseas properties worth less when converted back to Singapore dollars. Another key term is aggregate leverage. This simply tells us how much of the company is funded by borrowed money. MPACT's leverage is at 37.9%. This figure is below the 40% mark, which indicates how they are managing their debt. Finally, let's look at gross revenue and net property income. Gross revenue is the total rent collected. Net property income, or NPI, is what's left after paying for property-related expenses. Both of these numbers were lower compared to last year. The report points to two main reasons: the sale of Mapletree Anson in July 2024 and lower income from overseas properties, partly because of the stronger Singapore dollar. However, the report also highlights that if we look at just the Singapore properties, their performance was stable and even grew, excluding the divested property. Now, let's move on from the financial numbers to how the properties themselves are doing. This is the on-the-ground story. A key metric is the portfolio committed occupancy, which is at 89.3%. This means that nearly 9 out of every 10 square feet of space in their properties is rented out, showing continued demand. Then there's WALE, or weighted average lease expiry. This is the average number of years before the rental agreements in their portfolio expire. MPACT's WALE is 2.3 years, indicating a degree of income predictability for the near future. Let's look at two of their key assets. First, VivoCity in Singapore. This is their flagship mall, and it reported strong performance. Its net property income grew by 6.0%. Tenant sales are up 2.1% year on year. They've also been upgrading the mall. Phase 1 of the Basement 2 enhancement is complete, and Phase 2 is on track to open from September 2025 with new tenants. This shows they are actively investing in their assets. Over in Hong Kong, Festival Walk faced a different environment. Tenant sales were down by 3.2%. The report attributes this largely to a high volume of residents traveling abroad in April. However, shopper traffic increased by 7.8% following marketing initiatives. MPACT is also actively managing their portfolio. They have announced the proposed sale of 2 office buildings in Japan, with proceeds intended for debt reduction. This is a strategic move aimed at strengthening their finances and focusing on their portfolio composition. It also reinforces that Singapore remains a core part of their business, making up more than half of their total assets. So, how is MPACT managing its money and debt? This is what we call capital management. As we mentioned, their balance sheet is stable, with gearing staying under 40%. They have also managed to lower their weighted average cost of debt to 3.32%. Paying less interest on loans is a positive for profitability. Looking at their debt, it's well distributed. They don't have a large concentration of debt that needs to be repaid in any single year. For instance, in the next financial year, only 6% of their total debt is due for repayment. MPACT is also using hedging strategies. About 78% of their debt has a fixed interest rate, which provides protection from sudden interest rate hikes. On the income side, about 88% of their distributable income is either earned in or hedged into Singapore dollars, reducing exposure to currency fluctuations. For unit holders on record, the key payment date for the distribution of 2.01 cents per unit is Thursday, 11th September 2025. So, what's the big picture and what is the outlook? The company acknowledges that there are global challenges, which they call geopolitical and macroeconomic headwinds, making businesses and consumers more cautious. In response, MPACT has outlined its strategy. Singapore is described as their anchor of stability. Their Singapore properties, particularly VivoCity, have performed well and provide a strong base. They're also being proactive and adaptable. The sale of the Japan properties is an example of their active portfolio management. Going forward, the management's stated focus is to safeguard their rental income by keeping occupancy levels high, managing costs carefully, and continuing to look for opportunities to optimize their portfolio. To wrap it all up, Mapletree Pan-Asia Commercial Trust is reporting resilience in a challenging global market. The performance of their Singapore assets is helping to balance headwinds faced in other markets. Their strategy involves active management of both their properties and their finances, with a stated focus on long-term stability. And that's our breakdown of MPACT's latest results. We hope this has helped you understand the contents of their report. And as a final reminder, the information in this video is for educational purposes only and is not financial advice. If you found this video helpful, please give it a thumbs up and subscribe to our channel for more analysis. If you have any questions on the report, feel free to leave them in the comments below. Thanks for watching, and we'll see you in the next video.